These are the students to come up. 18C, BCD grade batch. What happened to others? 3, 4, 5 members are there, no? Excellent. You know, so then we can do the calculation there. It's lesson, right? So what is it regard? It's valuation, right? Valuation. So we are going to value now securities, right? Coordinators is the coordinator. Online students, can you hear me?
Yes, madam.
Okay, thank you. So then now we are going to value something, right? So value something in finance, we have the financial instruments, right? Therefore, this lesson includes the valuation of bonds and the other instrument is shares. Right, shares can be divided into two: preferred share valuation and the other one ordinary share valuation. Therefore, the lesson includes 3 components. Right, the first one bond valuation, the second part ordinary share valuation, and then the other one preferred share valuation. Right. All right. Okay. So we just identify the type of bond, right? Based on the type of bond, the valuation may be different. Valuation technique may be different. And then the other one, yes. Then we are going to value the bonds with the identification of type of the bond. And then, so we have to identify the yield measures. Yield in a sense, return measures. Current yield and then the yield to maturity. Last one, we have to consider the interest rate, the current interest rate, and then the bond prices. How these current interest rate and the bond prices are interrelated with each other. So this is the outline of the lesson. The first one, intrinsic value. So what we are going to do now, we are going to value something. If we are going to value something, what is the basis? The basis is intrinsic value, right? Intrinsic value. What do you mean by the intrinsic value? Intrinsic value refers to what? Present value of the future cash flows, right? Present value of the future cash flows regarding the NPV, like NPV. Right? So if we are going to value something, what's the value of something? It can be taken as the, yes, it can be taken as, yes. The value of the asset can be taken as what? Can be what? It's the present value of the future cash flows from that asset. We call it as an intrinsic value. So when we are considering this intrinsic value or its valuation, we need to consider 3 things. Right? First one, we need to consider what? The cash flow. It may be sometimes cash inflow or else out. Right? So when those things bring to the present context, the second one we need to consider what is it? The time period. Right? So with the time period, you need to consider the other one, discounting rate or else required rate of return. So these 3 things should be clearly identified when you are converting the future cash flows into the present context. Right. Okay, so this is how we can present the intrinsic value. What do you mean by CF? CF? Cash flows, right? Cash flow. CF1, what is it? Cash flow at the end of the first year, it's first year cash flow. CF2, what is it? Second year cash flow. CF3, cash flow in the third year. But these are the future cash flows. Future cash flows, how you can convert these future cash flows into the present context by dividing it with the 1 plus R to the power N. Right? R means, what do you mean by R? The last week we studied. What is that? Required rate of return or else the interest rate. Right? It may be required rate of return or else it may be the interest rate. Similar terms. Right? First year, second year, third year, and then end. Since we don't know the time period, we can continue until the end period. Right. So this is what we call the total. Right. So this is sigma now. So that sigma representing what? Total of these future cash flows. So therefore, if you are summarize the first equation, you can identify this second equation. Right. Example number 1. Quickly do it. Right. Read the question. Saraka. Saraka company is considering a purchase of generator to a new operator. Newly opened machine in Maharagama. The life of the generator is 3 years. The net cash flow from the generator are expected to be 25, 30, and then the other one 35,000 for the first year, second year, and third year respectively. What it asks, determine the intrinsic value of this generator. The required rate of return is 10%. Okay, quickly do it. 1 by 1, you need to convert into the present context. So if we draw it in the timeline, year 0, first year, second year, third year. Right? 25,000 first year, how much is it? First year, 20, first year, 25,000. Second year, 30,000. Third year, 35,000. 35,000. Right. So then we have to convert these future cash flows into the present context. How you can convert these future cash flows into the present context? By dividing these with the 1 plus R. How much is the R now? R is 10% or else 0.1. To the power, yes, to the power 1. Why it is? So this is the cash flow in the first year. 30,000 divided by 1 plus 0.1, that is the R or else required rate of return. Since it is a second year cash flow to the power 2. Third year cash flow 1 plus R 0.1 to the power 3. Summation of these 3 is what? The present value of all future cash flows from the asset or else from this factory. Hope you all bring the calculators. Now take out your calculators. You need calculators, otherwise we can't do this valuation lesson. Okay, take out your calculators. Okay, stand up those who are not having the calculators. Stand up. Stand. Those who don't have the calculator, stand up now. Okay. Those who don't have the calculators. Right. Including the coordinators. Very good. Right. So what we can do, don't have the calculators. Read 10 times. I will bring the calculator in next slide. Together. Like a soap. And then see. Right? Okay. Bring the calculator in next week. Tell it 10 times and sit down. Otherwise, I'm doing like this. You can stand up and do your calculations. Nothing to do. Okay, start. 1, 2, 3. I will bring the calculator in next week. Second one. For Katava, I will bring the calculator in next week. Next week all the same, huh? 25,000 divided by 1 plus R 0.1 to the power 1. It is 22,727. Next one, 30,000 divided by 1 plus R 0.1 to the power 2. That is 24,793. The last year, third year, 35,000 divided by 1 plus 0.1 to the power 3. It is 26,296. Right. Total of these three. It's 73,816.01. Right. You all got the same answer? Right. Online students, did you got the same answer? Online students? What's the answer for the question? No, any of you students? 002 exemption. Are you there? Silva. Silva? No. Shara. Shara. Gunasekara. Gunasekara. They are working students. Working students are there. Okay, the answer is 73,816.01. So what's the trading price? Trading price. The asset is trading at which price? Question itself given to us. What's the value? Trading price. Yield. Trading price, how much is it? Yes. It's trading at 100,000. It's trading at 100,000. If it is so, is it underpriced, overpriced, or else fairly priced? The value of this asset is how much? 73,813 or 60. The value means. But it's trading at the market to the 100,000. Is it overpriced? Is it underpriced? Or else is it fairly priced at the market? Huh? Huh? Is it market in the market? What's happened? Overpriced. Why? The value is 73, but it's trading at 100. It's reflecting in the market, it's overpriced. So then do we need to buy that asset? Do we need to buy that asset? Yes or no? No, we don't. Why should we buy the asset even if we have a value of the 73,000? Since it is trading at 100,000. So therefore, what should we answer? Since it is overpriced in the market, we should not buy that asset. Okay, that is done. Since it is overpriced, in the market, don't buy the asset. Or else company should not buy the asset. That's simply regarding the valuation, intrinsic value. I hope you understood the concepts. If we are going to value something, it may be asset, or we can take the value of that asset, future cash flows, but which value? Present value. Same type of a question. Just read the question quickly. Same type. Again, you are going to purchase a new machinery which increase the productivity. How many years? 4 years, which has a 4 years lifetime, and then it generates 25,000 fixed cash flows during this 4 years period. So then, what could be this one? What is this? Same cash flows during 4 years. What is this? What is this? Same cash flow during 4 years. What is this? This is a, yes, exactly, very good. It's an annuity. Right? If it is an annuity, do we need to take the present value one by one? No, we don't need. What we can do? We can take the cash flow and multiply it by the annuity factor. We discussed it in the last week. What's the annuity factor? Go to that lecture note and tell me quickly. So what we are taking is present value of the future annuities. Present value of the future annuities. 1 minus 1 divided by 1 plus r, 1 plus r to the power n divided by r, required rate of return, which gives us the annuity factor, right? Annuity multiplied by the annuity factor, it gives us the present value of these total annuities, where you can take it to the valuation of the asset. So therefore, I did not do this one. You can do it as a whole. Is this clear? Is this clear? Right. Right. So we'll move forward with that knowledge, with that basic knowledge, we'll move to the valuation of the bond. Right? Valuation of the bond. What do you mean by a bond? Tell me first, what do you mean by a bond? Now, boys. Yes. What do you mean by a bond? Okay, write it down. We discussed the basics. If you can't understand, I can't do anything for that one. Therefore, you have to concern very much. Basic has been discussed. Where are you? Lunch. At this time, why you should take the lunch? You don't have the time for the lunch. Yes, write it down. What is mean by a bond? And the last row, you can come here. Last row. We'll take this last rows to the first and second line. Come. Yes. No. Shayan to the next girl. Uta, Shayan. Next to that girl. Next to that girl. So then you can understand what we are discussing. Otherwise, you have to make an effort to understand. Right. Okay. Uta, just come. Right. To the seat. Okay. I'm not going to ask question, don't worry. But you can support from, you can take support from them. Boys, you are isolated, no? Right. We can take this last three guys. You are having Sharon with the other two girls. Come. We need another 2 points. In this meeting. You were there, no? It's okay. We don't need the phone to conduct lecture. Right. Okay, that is all. What is mean by a bond? Yes. What's the bond then? What is the bond? What do you mean by a bond? What do you mean by a bond? Yes. What sort of a security? Yes. What sort of security that is? Issued by, okay, let's identify from that point onwards. Issued by companies or else the government. Right? If it is issued by the companies, we can call it as a corporate bonds, and then if it is issued by the government, we can call it as a treasury bonds. Treasury bonds. Right? Corporate bonds and the treasury bonds. Anyway, issued by the companies or the other one, government bonds. Right? Issued to who? Right? Issued to who? Or else, why they are issuing the bonds? Why they are issuing the bonds? They need what? They need funds, right? So they need funds. So therefore, they are issuing the bonds to who? To who? To the potential investors, right? Bonds will issued by the companies to the investors, and then it's a what sort of security? Equity or debt security? It's a debt security. Fine. So then companies issued the bonds. Those are bond papers, right? Just the paper, A4 size paper, papers, right? So bond holder or as the investor take these bond papers and then he pass money to the company, right? So then from this point, bond papers, and from this point, so they are receiving, the company receiving the cash flows. So that's the initial contents. Later on, now we'll give the funds as the investors. You give the funds to the companies. Do you expect something from the company? Yes, exactly. Right? We are expecting something from the company for our investment on the bond. So therefore, during this maturity period, during this bond holding period, company needs to pay what? Company needs to pay what? Very good. Interest. But we have a specific name called as the coupon payments. We are not taking the interest for the bonds. What we are taking is coupon payments. During this maturity period, the company needs to settle the bond, the coupon payments to the investors. Now, right. Now the maturity period comes. Or else at the end of this maturity period, company need to again settle what? They need to give the collected funds to the investors at the end of the maturity period or as in number of period, right? So which is called as the redemption price. Redemption price. So therefore again companies issued the bonds to the investors. So Normally, it may be slightly higher than the face value, or else it may be slightly lower than the face value. Companies issue the bonds, and then in return, the investors make the payment for the companies, right? So bonds normally having the long period, it may be 1 year, or it may be 5 years, 30 years. During this period, company need to settle the interest, or which is called as the coupon payment. Coupon payment to the investors, plus at the end of the maturity period, the company again need to settle the collected funds from the investors, returning the funds. I hope it's clear to you. Is it clear? Is it clear? Okay, so then bond valuation. It's what? It's a debt security, or else it's similar to a loan, right? Redemption price means the maturity price. At the end of the maturity period, company need to settle, right? Okay. Debt security represented by the loan, and then typically issued by the corporations or government, and with the perspective of what? Raising the capital. Okay. The bond valuation. From the company side, company can issue the bonds, and thus they can collect the cash. Meanwhile, if they have the extra funds, they have the chance to invest in another company, or else other company will issue the bonds. So therefore, this may be including two perspectives: investing perspective, other one financing perspective, right? Valuation. So then we'll understand, or else we'll discuss the latter part. So which is identified under the investment activities, right? If we are come up with the, if we are going to invest in other company bonds, how we can value the bonds. Right. You can read this one later on, the difference between debentures and the bonds, and you can refer the note as well. Right. The bond features. Right, bond features. As we discussed, so we'll draw this one. We'll draw and identify. Yeah, the person Deepa BSAA. Okay. Deepa BSAA issued the bonds. The date is 2025. June 7. Right? Let's assume they issued the one bond. Right? Normally, the face value of this bond, is a bond paper. It has a face value. Face value of the bonds equal 1,000. Right? But when we are issuing this bond, even the value is 1,000, are we going to claim the 1,000 from the investors? Yes or no? No. Right? No. So therefore, issue price, even the value is 1,000, we are issuing it at a 990, slightly lower than the face value. Right. So then the investor need to settle 990 to the Deepa PLC. Right. The the bond value, the bond maturity period, it's 5 years. 5 years. Now, during this 5 years period, first year, second year, third year, fourth year, fifth year, 2026, 2027, 28, 29, 30. Okay. Now the company needs to settle the interest. Now you have to understand this one very carefully because the entire valuation is based on this scenario. And so it is a story. Right. 26. Now the company is starting the payment of interest. How much is the interest? Or else how much is the coupon now? Yes? Coupon. Coupon payment. Coupon payment. Coupon payment. How we can calculate the coupon payment? Write it down. Coupon payment equals. You have to draw it with me. I'm not going to try to again draw it. Coupon payment. Coupon payment equal face value multiplied. Ida තියලා තමයි ලියාගන්න. හරිද? දැන් මේ diagram එක අඳින්න ida තියලා ලියාගන්න. උදාහරණයක් විදිහට ida තියාගන්න. දැන් බැරි වුණා. Coupon payment equals face value multiplied by face value. Face value, face value. Coupon payment equals. Coupon payment equal face value. Face value multiplied by coupon rate. Coupon rate. Face value multiplied by coupon rate. Now, in this one paper, they mentioned that coupon rate, CR, coupon rate, coupon rate. Please draw this one. Coupon rate, or else you can name it as a CR. CR, coupon rate, is 10%. Now take me the coupon payment at the end of the first year. Right. Deepal, how much you are going to pay? Jehan, how much you are going to receive? 10,000. Below seeing in Dona, below seeing in the back. Yes. How much is it? 100. Right? Face value 1,000 multiplied by 10%. It is 100. It's 100 now. We are receiving Shehan, or Shehan receiving now 100 for the 2026 as one coupon payment. Right? Coupon payment for the second year, CP, coupon payment for the second year. At the end of Taurus, during this 27, how much the Shehan going to have as a coupon payment? What's the value then? Corner. What's the value? Coupon payment for the 2027. How much is it? Again, same value. How much is it? 100. 100. Coupon payment is not going to be changed. Again, 100. Right? Third year. CP3. Yes. 18 weekday students. Anyone? Yes, look up. Third year coupon payment Third year coupon payment 1,000, 10,000, 1 million, 100. That's what I now like about 100. Right. Exception student. Fourth year coupon payment 10 million, 100. CP4 coupon payment at the end of the fourth year. Yeah, what's your name? Yes. Sharon, not Sharon. David. Show. I can't remember the information. David. Fifth year, again 100. Right. So what happened now? Can you understand this 100 as what? So this is what? Same payment during the 5 years period. What is this? This becomes an annuity when we are valuing it. Right? So therefore you have to keep that. Remember, it may be an annuity, right? But maybe it's definitely an annuity. Right. Now, at the end of the fifth year now, 2013, 6 or else June 7th. Now, the Shehan is going to the company, right? Going to the company, then present these papers to the IPAL PLC. Now, at the end of this fifth year, the IPAL need to settle what? Need to settle. IPAL take a loan from the Shehan. Now he need to settle it. So he has given the period 5 years. During this 5 years, we are not going to settle something. At the end of the fifth year, we will settle something. What is that? That is the redemption price that you ask. Right? Okay. At the end of the fifth year, the respective date, Deepa is going to Shehan is going to the company and ask the funds. Right? So therefore, redemption price. Company need to settle what? Redemption price. Redemption price. In which day? 2030 June 7th. Normally, redemption price equals to what? To the face value. Right? So therefore, redemption price equals to the normally to the face value. Let's see. So this is the bond valuation lesson. Again, the PLC issued the bonds to the Shehan in the today's content. So then during the 5 years, the PLC need to settle the 100 rupees for the investor. At the end of the maturity period, then the Shehan need to present these bond papers to the company and request the funds that he has given to the company, which is called as the redemption funds. Any question from this one? Right. Okay. Hope it is clear to you. So then these are the sum of features that you need to understand. Face value is must. Right? At the end of the maturity period, what you are getting? Face value. During this time period, what you are getting? Coupon payment. Right. And then maturity period, number of years that you are going to keep this the bond. Right. So then for the face value, we are taking the letter F. Coupons, redemption price, redemption value of this bond, we are normally taking it as a C. Right? Coupon rate or else the coupon rate, it is called as the R, and then yield to maturity, I or else required rate of return, N equals number of time period, and then P equals purchase price when we are issuing the bond, and then CP means coupon payment. Coupon payment. So this is what we have identified. Therefore, bond valuation also equals 1 is definitely based on the intrinsic value. What do you mean by intrinsic value? Present value of all future cash flows. Right? Regarding the bonds, what are the cash flows? Now tell me. Regarding the cash flows, regarding the bonds, what are the cash flows? Future cash flows? From the company perspective as an investor. As an investor, what he is receiving now? Tell me. During the 5 years, he is receiving coupon payment. So therefore, the first category or else first thing is present value of the coupon payments. Plus, as now we are a company, but we have invested in somewhere else. At the end of the maturity period, the company is receiving what? Maturity value. So therefore, present value of the last year, redemption price, and present value of coupon payments during this period equals to what? To the value of the bond. Is it clear? Right. So these are the something other further equation. We'll identify those things later on. Anyway, this is the total of CP means coupon payment. You have to convert it to the present context by dividing it 1 plus R to the power n. And then present value of the maturity value. At the end of this nth year, we are getting what? Maturity value. MB maturity value. So this is how you can convert the future maturity value into the present context. F, that is face value, divided by 1 plus R to the power n. N equals the at the end of the maturity period date. Or else the years, number of years. Because why? We are converting like this. Plus, we are considering this interest or the coupon separately. Plus, at the end of the maturity period, we need to separately consider the maturity value as well. So therefore, both together is the value of the bond. Okay. Now, based on the type of bonds, we have to apply the separate or several measurement techniques, right? Anyway, the basic is same. With the type of bond, what are the things going to be changed? Only the cash flow, right? First one, we have 3 bonds: poor discount bond, coupon bonds, and the last one, what is it? Perpetual bonds, right? So we'll identify first poor discount bond, right? Poor discount bond equal is single cash payment at a fixed future date, right? When the company issued the bonds to the investor, so there the company promised that, okay, we'll give a payment at a fixed date without having what? Without having the coupon payments, right? Only the maturity value. They are not going, this type of bonds, they are not going to pay the coupon payment. Just they acquire the funds and get at the end of the maturity period, they are going to settle this fund to the investors. Then we type bond type cash flow එක වෙනස් වෙලා valuation techniques වෙනස් වෙගෙන යනවා. Okay. So if it is a poor discount bond, what are the cash flow in line with this poor discount bond? So we have 2 cash flows. First one, coupon payment and the other one maturity value. Out of these two cash flows, which are relevant for us? What is relevant for the poor discount bond? Exactly. They are not going to have the coupon payments. They are only having one maturity price. So therefore, value of the bond equal present value of what? Maturity price. Present value of the maturity price. Or as the face value. Maturity price normally equal to the face value. So therefore, value equal face value divided by 1 plus R to the power n. Okay, example number 3. Now do it. Okay. Read the question. DNT PhD has issued 1 year forward discount bond with a face value of 1,000. Required rate of return for the investor, it is 15% per annum. How much will he pay to purchase the 1 year forward discount bond of the DNT PhD? Right. When you are writing or else when you are doing the calculation for the bond valuation, from the last week onward, I asked you to first name the items and then go to the question. Just identify what is R, what is I, what is coupon payment, and write down those things first. What you are thinking about. Face value equal 1,000. R Agami. What's the rate, interest rate, or else what is the required rate of return? 15%. Right. So then how we can value it? Do we have a coupon payment, CP? Yes or no? No, we don't have. Do we have a CR, coupon rate? No. Why? For the poor discount bond, we are not receiving the coupon payments. Right. Value equals. Value equals. Okay, with the name, Coach, after long time. So this is the first time we are meeting business finance lecture. You just came for the first lecture and second lecture. Only first lecture, no? Right. Face value divided by 1 plus R to the power 10. Face value 1,000 divided by 1.5 to the power 1. What's the value? What's the value? 869.56. 869.56. Right. Now they are explaining that the asset is trading at which value? Current market price of this asset or its bond is. It will given to you. What is it? 800. 800. Now, even the value is 869 is trading at 800. What happened in the market? What happened in the market? What happened in the market now? The value is 869, but it's trading at 800 rupees. What happened in the market? It's underpriced in the market. Because while the value is high, but trading at low price. Do we need to purchase the bond as the investor? Yes or no? Yes, exactly. Why? The value is 869. It's trading at 800. We need to purchase the asset. We need to purchase the bond. Okay, write it down. Since the value of the bond, is higher than the trading price, investor need to purchase the bond. Okay. Done. Now, the second type of a bond, that is coupon bonds, right? Second type of the bonds, it's a coupon bond, right? Issuer's perspective, that means companies. Again, press to capital. Right, so they issue the capital, but from the investors, we are not going to pay the income or the coupon payment. So it's interest, right? But what we are doing is we are initially paying the capital. Company taking the capital, and then they are not going to pay the coupon payment. Anyway, they are going to have the larger funds for issuing that sort of the investment. So there may be some sort of investors who are looking not for the interest but for the capital appreciation. Because why? So if we are going with this poor discount bonds, if they are not paying the interest, normally they are issuing those things as a with the lower price, right? We are purchasing for 800, but at the end of the financial, at the end of this financial period, company is going to settle the loss. So therefore, the capital appreciation is high in the poor discount bonds. Right. Okay. So then, coupon bonds, right? As name implies, so these sort of bonds, they are issuing for a number of years, and then number of years with the maturity price as well as the future payment. So therefore, coupon bonds, so they have two types of cash flows, but those are coupon payment during the maturity period plus redemption price at the end of the maturity period. Right. Now, if it is a coupon bond, again we have two cash flows. That means again you need to consider the value of the bond equals to the present value of the coupon payments plus present value of the face value or redemption price. So this part identified CP multiplied by 1 minus 1 plus R to the power minus n divided by the R. What is that? What is this? What is this? What is this? What is this part? What is this? What is this? Look at this. What is this? I promise you I'm not going to ask the question here. मैं और support करना right, okay. So what is this? You were there when we are discussing about that one. What is this? Huh? This is an annuity. Within the brackets, what we have mentioned. Annuity. Annuity. Annuity factor. This is annuity factor. Or else, if you write down this one, it's like this. 1 minus 1 divided by 1 plus r to the power n divided by r. Right? Say why we have taken this one to the upper part of this equation by including it as a minus. Or else 1 divided by 1 plus r to the power n equals 1 plus r to the power minus n. Okay, hope it is clear. The valuation part is clear. So CP is annuity. It becomes annuity. So therefore, we can multiply it by the annuity factor and take the present value of the cash flows. Now the thing. If it becomes a semi-annual coupon bond. Previously, we discussed the annual coupon bonds. The coupons are paid based on the annual. Now, if it becomes the semi-annual coupon bond, how you can measure it? How you can measure it? The technique is, now we are getting coupon payment twice a year. So, therefore, coupon payment should be divided by the 2. Why? Semi-annual coupon. Plus, interest also receiving 2 times divided by 2. How many times we are receiving the interest? N multiplied by M, or else the, yes, N multiplied by M means M equals here 2. Last week we discussed multi-compounding the technique. So it is involving here R divided by 2 plus N multiplied by 2. So we have to do the question number 4. It includes both 2 concepts. Discuss with your friends and try to do it. Identify the payments, identify the items, and then name those things. Maybe station only is going to do the question. So they are going to do it. I don't want one. Then after you are going to do the calculation on both. Five-year coupon bonds. N equals then N equals 5. Right? Then face value. Face value. If we go face value equal 1000. Where should I place this 1000? Where should I place this 1000? At the end of the 5th year, we are getting what? Plus 1000. Why the maturity period is 5 years. Coupon rate CR equals CR coupon rate. Coupon rate. I don't have the question. That's why I'm asking. Coupon rate, anyone? 10%. Coupon rate 10%. So then CP coupon payment 1000. Now else again face value multiplied by coupon rate. It is again 1000 multiplied by 10%. 100 rupees. You are getting 100 rupees first year, second year, third, fourth, plus the last year as well. 100. Right? So this 100 becomes the annuity. This 100 becomes the annuity. So therefore, value of the bonds equals. So do it. Value of the bond equals two components, right? First one is face value, present value, plus coupon payment multiplied by 1 minus 1 divided by 1 plus r the power n divided by square rate of return. So that what we are doing is we are taking this 100 present value plus separately the 1000 present value. Both together is the value of the bond. Okay, share on. 18 a week day. You can do it. I know about you. Come. Okay, do it. Do it. Those who have completed it, go to the second one that is based on the semi. Are different, we are different. Open payment, open rate is open rate different, interest rate different. Yes. What the current market interest rate or as the required rate of interest of the investor is required rate of return. Face value is 1000. Face value it is 1000. Face value it is 1000. See here, coupon bonds that pays 10% coupon per annum. What is it? That's the coupon rate. But the required rate of the investor, the required rate of investor, how much is it? It's 8%. It is R. Investor expecting some interest rate, but even the investor expecting 8%, company is paying how much? 10% more than the investor's expectation. Therefore, R is 8% and then coupon rate is 10%. Coupon rate, it's correct. Coupon payment, okay. And then to the power. To the power, it should be here. To the power n, n is 5 years. Divide it by the entire formula should be divided by 0.08 plus 1000 divided by 0.08 is 1000. Occurred at which year? Occurred at 50 years. So therefore you have to consider it as the right. Okay. Exception students. What's this part? 600. What's that? Don't need for it. 100. What's the value then? What should I make? What's the value here? What's the value? This one 400. 400. 400. Exactly 400. First calculate the annuity factor and tell me. You all calculate the annuity factor and tell me. 1 divided by 1 plus 0.08 to the power n. 1 minus the answer divided it by 0.08. Annuity factor is 3.99. Am I correct? Yes. Multiplied by 100, that is 399.2 approximately equals to 400 plus 1000 divided by 1 plus R 0.08 to the power 5. What's the answer here? 680.58. The answer then total 1080.58. Right? Sorry? Is this the answer you all got? 20. 620. It's value 680 gutta, right? 680, right? Do the same question. If the bond is having the coupon payment in the semi-annual basis. Do the same question if the interest are paid on the semi-annual. Semi-annual interest. Semi-annual means for 1 year we are getting interest for 2 times. Coupon payment should be divided by 2, R should be divided by 2, N should be multiplied by 2. All R need to be divided by 2. Why we are getting now interest for 2 times, and then N multiplied by 2. Why again we are getting the interest for 2 times, that means semi-annual, and then coupon payment, semi-annual coupon payment need to be considered. Value equals coupon payment divided by 2. 1 minus 1 divided by required rate of return. Again R divided by 2. N multiplied by 2 divided by R divided by 2. Plus face value divided by 1 plus R divided by 2. N multiplied by coupon payment, that is 100. Semi-annual divided by 2 multiplied by the annuity factor. 1 minus 1 divided by 1 plus required rate of return, that is 0.08 divided by 2. N means 5 years divided by multiplied by 5. Entire formula should be divided by 0.08 divided by 2. Plus percent value of the face value 1000 divided by 1 plus 0.08 divided by 2. The power 2 multiplied by 5. It's 50. 50 multiplied by 8.11. The first part of this formula is equal to 105 plus 1000 divided by 1 plus 0.04 to the power 10 is 675.56. Both together equals to 1080. Okay. So you can have a 10 minutes break and come. Okay. You all got the same answers? Pass the book. Right. Okay, we'll have a 10 minutes break and come. If you have any question regarding this question number 4, you can take it. Others, you can have a break. Only 10 minutes. Huh? Okay, meanwhile, I will explain QR code, right? For the last week as well as. So we first mark the last week QR. Okay. Last week you were unable to mark QR code. QR code last week. This is the QR code last week. Yes, last week we were unable to mark it. Some of you marked it, but some of you are unable to mark it. I know some of you are presented in the last week. Anyway, so this is a bonus. Hope you all marked it. Tekvinder, can you mark this one?
Hello, Miss.
Yes. Already marked it, right? But we take last week now you can have your break. I mean, if you want. Those who want to have the break, they can go outside and scan the QR. Otherwise, those who are staying here, they can scan the QR. No issues. If you want to break, you can go. Scan the QR. You can have your face. Now it should be okay. We'll start. We start the next type of bond, evaluation of next type of bond, that is perpetual bond. Right? Perpetual bond. All right, shall we start? Hang on. Really ready? Get a method. No lights. Right. So we'll start the third component, that is the perpetual bond. Right? So this bond type is perpetual bond, which will play at the end of the during the maturity period, and most probably it is there are no any definite time periods for this kind of a bond. Until the infinity, the investor is getting fixed amount of coupon. Right? That means no maturity period. We just give the some amount of money to the company. So then during the long run, they are paying what? Only the coupon payment. Right? If it is so, how you can value the coupon bonds? How we can value the perpetual bond? What are the cash flows relevant for the perpetual bonds? Yes, cash flows relevant to the perpetual bonds. What those are? Yes. Very good. Only the coupon payment, right? Until or else during this infinity time period, what the investor getting on only the interest. So therefore, how we can value this perpetual bond? Coupon payment divided by the required rate of return. This is the value of this bond. Right. Question number 6. Question number 6. Question number 6, a very simple question. Very simple. Required rate of return, right? Coupon payment is 16%, face value is 1000, required rate of return is 14%. So this is what perpetual bond, right? So you have to understand the type of bond first. So then based on that one, you identified what are the cash flows relevant for that type of bond. So that is how you can value the respective asset. Right. Value of the bond equals. Before moving to that one, you need to summarize question. Interest rate. How much is the interest rate? Tell me the interest rate. Interest rate. I need the support from you. Do it. Do it. 14%. Coupon rate. Coupon rate. 60. Face value. 1,000. Right. Coupon payment CP. Coupon payments. How you can calculate? 1,000 multiplied by 60%, that is 160. 160. Okay. How you can value this type of one? Coupon payment multiplied by 1 over R, or else coupon payment divided by the required rate of return. Say coupon payment 160 multiplied by 1 over R, that is 0.14. 160 divided by 0.14. What's the value there? What's the value there? What's the value? Black color t-shirt. Last row. For the last row. Yes. What's the value for the perpetual bond? 1,142. 1,142.85. So this is the value of the bond if it is a perpetual bond. Here, now the valuation part done. Right? The second part of lesson, identifying the required rate of return. Right? The required rate of return, or else investors expected return rate. It is coming as a new term called, what is it? Are you laughing? Yes. Right. What? No issues. Right. Okay. Coming as a with the new word, what is it? Yield. Same word to the return. Right? Yield and return are same. Yield measures or else return measures. Return measures, there are two measures. The first measure is current return, or else we call it as a current yield. Right? Current yield, and the other one, what is it? Yield to maturity. That means return until the maturity. How much investor is getting on this one as a return until the maturity, right? Yield to maturity, right? Very simple. How we can calculate the current yield? Current yield. Now thinking, I have invested in the bonds. Now I am getting the coupon, right? I am getting the coupon. So then, how I can calculate the current yield? Current yield in the sense, at present, how much of return you are earning on this the bond? Current what you are getting? Coupon, right? Coupon payment is getting on currently for what? Coupon payment is calculated based on the face value, but we are receiving this coupon payment for currently for what? For the market price of that asset. Right? So therefore, current yield or else current return can be identified as a How you can calculate it? How you can calculate? Read the example. Bond annual coupon dividend or else the return coupon divided by the bond price or else expressed as a percentage which is identified as the current yield. So then, for example, if the bond has a 6% coupon rate per value, so par value is 100 rupees, 1000 rupees, par value is equal to what? Par value, face value, similar names. If you want, you can write it down. Par value and the face value are similar names. Right? The value of the face value of this bond is 1000. Now its price is or else it trading at 1010. How you can calculate the current yield of this bond? What you are receiving now? For what you are receiving? What you are receiving? Coupon. What's the coupon? Calculate the coupon here first. What's the coupon here? Coupon is coupon is coupon is what? 1000. That's 6. Six divided by yes, bond price. What's the bond price then? Can online students see this? Working? It's sharing. I don't know whether they can see it. Right. Online students. One price. What's one price then? Price of the bond. Price of the bond or else trading at 1010. So therefore, 6 divided by 1010 gives us the current yield. How much is it? It should be 60 divided by 1010, it should be 5 point. This is the current yield. So then how you can identify the current yield? Annual coupon. Right? Write it down. Current yield. CY equals annual coupon. Annual coupon divided by bond price. Annual coupon divided by the bond price. Currently, what we are getting as return. Okay. Clear? What's the money? The key comment on the comment. Right. So then. Now the next one, next yield to maturity. Write it down. Yield to maturity. Yield to maturity. Yield to maturity. Or else, how much of return we are getting on this one until the maturity. Right? Maturity period එක දක්වා කොච්චරක් හම්බ වෙනවද තමයි අපිට මේ bond එකේ return එක කියන එක තමයි බලන්නේ. Right. If we are identifying, okay, now we take it. We are identifying the return on this bond until the maturity. How much of that? How much of return we are receiving on this bond? First one, coupon payment. It's also what? It also a return. Plus, at the end of the maturity period, we are receiving something called as the base value. Base value is that base value similar to the issue price? No. Definitely. So therefore, at the end of the maturity period, what we are receiving, we may have some capital appreciation. Right? It is also an investor's return. Is that clear to you all? Okay. Now, you invest in the bond. Now, what we are finding, yield to maturity represent, right? Yield to maturity represent until the maturity. Right? Until the maturity, what is the return that we are receiving on this bond as a percentage? Again, until the maturity, make even an account. How much of return we are, or else how much of yield, or else how much of return we are receiving on this bond. මේ කාල පරිච්ඡේදයේ අපිට හම්බ වෙන මේ බොන්ඩ් එකේ ඉන්වෙස්ට් කරාට පස්සේ අපිට හම්බ වෙන රිටර්න් එක කීයද කියන එක තමයි අපි මේ බලන්නේ. Right. So if we are identifying the return on this bond during the maturity, we may receiving two components. First one, during the 5 years, we received one coupon payment. Is that coupon payment is our return? Obvious, exactly. That's a return for the investor. Right? Plus, we are receiving something at the end of the maturity period. What's that? දැන් මේ අවුරුදු 5 පුරාවටම හම්බ වෙන ඉන්ට්‍රස්ට් එක එහෙම නැත්නම් කූපන් එක. ඒක මොකක්ද අපිට ඉන්වෙස්ට් එක? ඒක රිටර්න් එකක් නෙමෙයිද? ඒක රිටර්න්. Plus, at the end of the maturity period, the investor is receiving the face value as well. Is that a return? Then, already we have spent something at the beginning of this bond. It is called as the issue price. We pay something. To acquire this bond, we pay something to the company. So therefore, the difference between that payment plus the other one at the end of the maturity period, the receiving amount, it is called as what? Capital appreciation. ගත්ත කීයටද 990ට. අවුරුදු 5කට පස්සේ හම්බ වෙනවා කීයක්ද? 1000. What's the difference? 10 rupees, or it's 900,000. That is the 100 rupee difference is there. What is this? This is a capital appreciation. As a return or as a percentage, we need to identify these two components together and calculate one yield to maturity. තේරුණාද? එතකොට අවුරුදු 5 පුරාවට හම්බ වෙන ඉන්ට්‍රස්ට් එක එහෙම නැත්නම් කූපන් එකත් අපිට රිටර්න් එකක් ඉන්වෙස්ටර් කෙනෙක් විදිහට ඊට අමතරව අපි අවුරුදු මේ මැචුරිටි පීරියඩ් ඉවරනහම හම්බ වෙන කැපිටල් ගේන් එකත් කැපිටල් ඇප්‍රීසියේෂන් එකත් අපිට රිටර්න් එකක් ඉන්වෙස්ටර් කෙනෙක් විදිහට මේ දෙකම එකතු කරපුවාම මේ බොන්ඩ් එක මත හම්බ වෙන රිටර්න් රේට් එක තමයි අපි කියන්නේ මොකද්ද? yield to maturity. Right? The way how we are calculating it, so that we can have the IRR formula to calculate the yield to maturity. Okay. Did you remember how we can calculate the yield to maturity? Or else IRR? Right. Okay. The lowest discount rate, ADR, plus the SPV and lowest discount rate divided by NPV and highest discount rate, difference between NPV and lowest discount rate and the highest discount rate multiplied by the difference between these two rates. Okay. We'll do the question number 7. Meanwhile, we'll identify the yield to maturity. Very simple terms. Even terms are doing things. So the behind the term behind the content is very simple. Right. Okay. Read the question very carefully. Now, assume this is you. Right. This is you. What you are going to do? An investor purchase a 5-year annual coupon bond. What's the maturity period? 5 years. 5-year coupon bond. This is a what? This is a coupon bond. There are 2 payments. What those 2 payments? Coupon payment and then the other one face value at the end of the financial year maturity period, which pays 6% per annum for the as a coupon. That means 6% is what? Coupon payment. Purchase for what's the value? 883.40 cents. What is that? That is one price, purchase price. Currently trading at 883.4, which has a base value 1000. 1000 is the value, but at the end of the 1000 is a base value, but we have acquired for 883. Right. Yield to maturity. Calculate the yield to maturity. Right? Now we can calculate regarding this question. What are the cash flows? 2 cash flows. First cash flow, coupon payment, and the other one, what is it? Very good, it's face value. So now we prepare the NPV2 tables to calculate the IRR. I just wait for you. You have to do it with me. I'm not going to do it. I'm going to explain, right? Otherwise, my calculations are very bad now. That's why. Okay. Right. Do it with me. First, draw this table here. Right? Here. First, draw the column here. Right? Here. Online students, I'm calculating the question on board. Can you see it? I'm annotating the presentation. Can you see it? Students, can you give me the feedback?
Yes, Miss, we can see.
I'm annotating you. You can see it, no?
Yes,
Right.
we can see.
Okay, thank you. All right. Okay. And first column here, right? So we can identify here 0 also we have a cash flow, right? So we are going to calculate the NPV. So therefore here 0. First year to the year 5, right? First year to the year 5 and then the last year, that is year number 5. Right? Second column, cash flow. Regarding this one, what are the cash flows? Right? Regarding this one, what are the cash flows? At year 0, we are going to purchase the bond. So if it is so, we have a purchase price. Purchase price. Right? We have a purchase price. During these 5 years, but we are going to have coupon. So therefore, first year to the last year, continuously as an annuity, we are going to have what? Coupon payment. Within the brackets, mark it as an annuity. I hope you all have the idea regarding how to calculate the IRR. At the end of the 5th year, what we have? Redemption value, or else within brackets, write it down. Face value. Face value. Cash flows. How much is the purchase price? 883.4 within the brackets minus. Right? It's a cash outflow. Right. Coupon payment. How much is the coupon payment? Coupon payment. What's the value of the bond? Face value. Okay. Mark it as a working number 1. Right? Take in working number 1. W1. Coupon payment, how you can calculate? 1000 multiplied by 6%, that equals 60. Continuously, as an annuity, during these 5 years, we are getting a coupon which is similar to the 60 rupees. At the end of the financial year, we are getting what? Not financial year, redemption at the end of the maturity period, exactly we are getting face value, it's 1000. So these are the 3 cash flows during the 5 years. Right? Okay. Now, we'll apply the discount rate 5% first. Okay. Apply the discount rate and quickly take the discount factors. For the coupon, you need to take the annuity factor, not the discount factor. Why? We are considering it as an annuity. How we can calculate this 4.3? Working number 2. Working number 2. Here, working number 2, W2. W2, this is W1. Right? 4.3. How you can calculate this 4.3? It's equal to 1 minus 1 divided by 1 plus R to the power N divided by R. Right. 1 is similar, 1 divided by 1 plus R. What's the R there? Required rate of return. Anyone who can tell me the required rate of return regarding this question? Galle කියනවා. Galle කියලා බලන්න කියනවා required rate of return එක කියන. කීයද? ඊළා නෑ. එයාව තමයි මේ මොකද්ද? එයාව තමයි මේ හොයන්න යන්නේ. එහෙනම් අපි ඒකට තමයි ගත්ත මොනවද? discount rates දෙක. What's the first discount rate? 0.05. 0.5. You are not allowed to take photos. You will have to do it and you will have to upload that document to the LMS. Right? Once you complete this one, that is the same assignment. At the end of the lectures, we have assignments too. We miss the time value of money. Right? Anyway, today's one is you have to do the question and then you have to upload it to the LMS. I will open the link before 6. Right? Okay. So then, power 5. Divide it by 0.05. What's the value? Quickly take the values. Just we are calculating the IRR. To calculate the IRR, we need what? We need two discount rates. Ne? First discount rate is 5 and the other one that's 12. What's the rate? 4. Very good. It's 4.32. Is the balance. But number 2 is 4.32. 329. 329. So therefore I have taken it as a 4.33. 4.23. I asked it to come to this one. Now we can make okay. The last year. How you can identify the last year one? Working number 3. W3. W3. How you can tell? I mean it is W2. Online students, you also need to upload the document before seeing. So I will give the time. So you have to do it. So that is today's assignments. I'm not going to give any excuses. Very basic thing. You are doing the question and you have to upload it before the sales. Right. There we are. W3. Working number 3. Right? 1 divided by 1 plus R 0.05 to the power. Anyone else can explain me to the power? Yes? What's the value should be there? Very good. It's 5. What's the value? What's the value? What's the value? 1 divided by 1 plus R to the power n. 0.78. 0.78. That is working number 3. Working number 3, 0.78. Okay. Now, multiply the discount factor with the cash flow and take the discounted cash flows. BSAA. What is that? Discounted cash flow. 883.4 multiplied by 1. Again, minus 883.4. 60 multiplied by 4.33. It is 259.74. The last year, redemption price multiplied by the discount factor 0.78. It gives us the 783. Now, take the NPV of this column by taking the plus minus values. Just take. Okay. Add these together and then minus the 883. Then 159. Yes. Right. Now we move the second discount factor. The next column, second discount factor. Calculate discount factor for the 12. Identify the discount factor for 12. How you can calculate the anything factor? So clear. 0 here 1. So therefore 1 multiplied by the cash flow 818.4 again minus cash flow. How we can derive this 3.6 working number 4. So I need to do this one now, working number 4. Working number 4. W. How you can calculate the energy factor there? 1 minus 1 divided by 1 plus R. Now R is 0.12 by discount rate. What is discount rate? The discount rate is 12%. 0.12 to the power during how many years? During 5 years period. We are finding the annuity factor for 5 years. So therefore to the power 5 divided by entire formula should divided by 0.2. Entire formula should be divided by 0.12. What's the value of the? What? You got the same answer. Take it 1 minus 1 divided by 1 plus R to the power n. N is 5. Again, whole formula should be divided by 0.1. Since we are taking the limiting factor. If you are practicing these things at class, so now you can get the idea regarding annuities. This is practice. Otherwise, you can't do the business finance. You have to do the calculations. Otherwise, at the end of the course, you will be in a trouble. Right. So it is set up with a 3.6 annuity factor. Right? Working number 5. Working number 5. Working number 5. Working number 5. W5. What is that? Calculation of the discount factor at the end of the 50 under the discount rate of 12. 1 divided by 1 plus, now R is 0.1 to the power, here, to the power 6, 4, 5. දැන් මේ බලන්නේ කොයි වෙලී අවුරුද්ද අවසානද? මේ 1000 ගැන බලන්න මේ 1000 under the discount rate of 12 at the end of the 5th year. So therefore to the power 5. Good. So it is 0.57. Multiply the discount factors. This column, right, with the column C. Just the numbers, just the figures. Let us equals A multiplied by. Okay. By adjusting those things, calculate the NPV under the discount factor 12. Consider that answer. Last column A and B and just letters. That shows how you can get the last column value. A means discount factor column, C means cash flow column. You have to multiply these two columns to have the last column. That means discounted cash flow under 12%. DCF under 12. Okay, now we have two NPVs. How we can calculate the IRR? Shall we calculate the IRR? Did you all finish this workings? Did you all finish the workings on NPV? Alright, so we'll move to the IRR calculation. Okay. Lowest discount rate or else lowest discount factor. What is that? It's 5. Lowest discount rate is 5. Highest discount rate, that's 2. So therefore name it LER. And this one highest discount rate. Out of these two discount rates, lowest discount rate, how much is it then? 0.05 plus NPV at lowest discount rate. NPV at which rate? Lowest discount rate, it is 159 divided by lowest discount rates NPV, again 159 minus NPV at highest discount rate, that is 100. Multiplied by the difference between lowest discount rate and the highest discount rate. Lowest is 0.05, highest is 0.12, or is 12 and 5. First do this part, right? And then add that value to the 0.05. Tell me the answer. Minus here it should be minus minus. Neither. This one should be within the bracket because why this is the minus values. That make more because here 59 එකතු කිරීම 100. Now it should be 259. 159 divided by 259 multiplied by 0.07. What's the answer? 0.9. I know. Okay. So now ask the time. And then 59 divided by 259 multiplied by 0.07. Okay, what's the value there? This part value, how much is it? 0.05 plus 0.042. Am I correct? Yes. The final answer is IRR. Abilities of things. IRR equals 0.092 against 9.6%. So this is what? This is what? Yield to maturity, right? On respective investment of this bond, investor is getting as a return how much? 9.29 or 9.2. Is that clear? Right. Oh. It's 2 minutes. Current yield and the capital gain. How much is it? Regarding this bond, we complete that one as well. Regarding this bond, what's the current yield? And just calculate it. In coupon payment 60, purchase price it's 883.4. How much is it then? Current yield. Quickly calculate current yield. And combine interest method coupon payment. Purchase price one shot here payment. What's the value? Current yield equals 0.0667. That means 6.7. Right. Capital gain. Capital gain. How you can calculate the capital gain? At the end of the maturity period, we are getting 1,000, but we purchase it for 883.4. That equals 6, 17, 117.6. That's the capital gain. So therefore, write it down. Current yield equals 60 divided by 883.4 equals 6.7, and then next line, capital gain equals 1000 minus 883, which is equal to capital gain as the 117.6. Right. Okay. Scan the document. Now take the pictures and scan the documents and upload to the LMS and you create the link. Right. Online students, you can do the same thing. Just take the photos of your work and upload to the LMS quickly. Only 10 minutes for the uploading process. This carries 4 marks. Last week 1 and this week 2 marks.